Hey, my name is Drose. I'm the founder of Bleeker Street Research, an activist short selling firm, and I'm here to discuss how we think about expanding the opportunity set of activist shorts beyond sort of the traditional frauds. I think the activist shorts have traditionally focused on things that are frauds, things that are faking revenue, things that you would look at and 80% of the revenue is just completely made up. And I think that's amazing. And those are few and far between, and they're very hard to uncover. And they're usually bigger in size, and people don't want them to be uncovered. So you're working very hard. The average stock falls. So you're missing things that are bad businesses, things that have key business issues. And, there's a very narrow sliver of the market that activist shorts have traditionally focused on. And that is things that are, you know, whether it's a fraud or a promotion, whatever you want to call it. But you're missing a large part of the market that's actually falling in value. So you're missing all sorts of things. And I think that what I want to do with Bleeker Street Research as we bring it back, is that I want to focus on things beyond just frauds. Focus on things that have critical business issues that are being misunderstood, things that have vulnerabilities that are misunderstood, and companies that are just telling a story that it's not fraud, but it's also not true, and the shareholder base doesn't understand that. So things where the shareholders of a company, I talked about how the people on the other side of a trade, you have to understand what they care about. When you can do research to figure out that those things that they care about are wrong. So, I consider that like a divergence of perception. So I'm looking for what reality is. And when that divergence is big enough, I don't think you need fraud. I don't think it has to be completely fake. I think that you can go after companies that are just misrepresenting themselves. And I think that that can become a source of alpha in the future. And I don't think people have fully explored that in the activist short world. I think people are very focused on things that have, 80% of stated revenues are fake. And, that is hard to find. That's hard work and it's good work. But the people on the other side of that trade are straight up criminals. Wirecard is not an easy short, despite the fact that it was a fake company. And, people were talking about it from 2011, 2012, 2013 on. 8 years later, it blows up. I think we'll see how that plays out. But these companies that have criminals on the other side of them, they can last a lot longer, and they're hard targets to go after. And so I think that you can focus on things that are, have critical business issues that the shareholders don't understand about. And it might fall well short of fraud, but that doesn't mean that the stock can't fall 30, 40, 50%. And I think when you're highlighting that, you not only create the alpha from, whatever the stock happens to do, but, you have a lot of kind of secondary benefits when you're publishing your own research. And that includes access to former employees, people that come out of the woodwork and either validate or invalidate your thesis. And it helps you better understand what the other side of the trade actually cares about. So, you write something about a company and, a dozen shareholders reach out to you and they want to talk. After you're done talking to them, you're going to better understand the bull case. And that helps you better understand whether you're right or wrong. 15 to 20 former employees usually reach out, depending on the company. But, I've had things that I've written where, 25 former employees reach out and all of them said almost the exact same thing. And that's like, you're onto something. So, it can fall well short of being a fraud. But, I talked about it a little bit before, but American Addiction Centers in 2015, I think 30% of their revenue was coming from urine testing. They were charging insurance companies $1,000 per urine test. So they looked very profitable and they were growing very quickly. Unfortunately, insurance was cracking down on this urine testing. And when American Addiction Centers went bankrupt in 2020, urine testing was, I think, less than 5% of their revenue. So that was a call. There was other issues with that company, obviously. But I think that's the kind of call you can make where you say, hey, look, this is how the company is actually making money. It's going to go away. Or there's going to be these issues. You just looked at the revenue and how much money they're making. That's great. But how are they actually making that money? And to do activist kind of short selling around identifying how companies are actually making their money, and if there's a substantial divergence between how that is happening and what people think, I think that is almost just as compelling as fraud, because at the end of the day, you're looking for stocks that are going to go down. And just because something is a fraud does not necessarily mean that it's going to go down. For example, some people underwrite a stock in a way that is almost scientifically or economically impossible. You could look at Tesla's insurance business, for example, as an example of something where, they're underwriting 50% margins and the most that they could do is 10. But the people on the other side of the trade, the people that are long that stock, really don't care yet. They're believers. They're willing to hold. And so that's an example, of a divergence, I guess, that hasn't worked yet. And I think these things kind of don't matter until they do. You look at Valiant. There was questions about Valiant's model from 50 to 225. It didn't matter until Hillary Clinton's tweet. I thought that they, were buying increasingly worse assets, but they almost acquired their way out of it. If they had been able to acquire Allergan, it might have all worked out, and Pearson might still be a CEO that, people call an outsider. You have to understand that they can keep going for longer, and that they can, the more access to capital they have, the more real that they can make the business seem by doing acquisitions and things like that. And that's where I think, people get into trouble with, like, oh, they did an acquisition of a company, their organic revenue's down 15%, headline revenue's up 20. But the people that own the stock see 20 and they're really happy. You have to understand what they care about. They care about that top line number. So you have to understand when that is going to change. And I think that was the lesson from Valiant, was you had to understand what people that were long the stock cared about. And when that started to change, that was when it broke. So, for a recent example of kind of the more like real business is the RealReal. They're a secondhand online luxury authenticated marketplace. Their kind of pitch to investors was, we authenticate everything. It's authenticated by professionals. We have this website that you can sell your goods on it, and we take 35%. That we have a take rate. That's our take rate. The bull case was that take rate's going to expand to 40, 50%, and they'll be profitable. And their largest expense line of authentication is going to become smaller over time, because AI and machine learning are going to, solve that problem. Unfortunately, when you start digging into the RealReal, you realize that, you talk to former employees, and it was basically like, this is as much a technology company as it is just a website. Someone has to evaluate it. They're not making any progress on this. The AI and machine learning thing is a joke. And the CEO, to bring it full circle, the CEO was the CEO of Pets.com. So she had, she was responsible for one of the shortest lived public companies of all time. It goes public. It's telling the story. And in the, it's saying we're going to be there by 18 months. One of the most interesting things I thought was the CFO on the Q1 call says, we're seeing take rate pressure. And the CEO jumps in and says, we're not seeing take rate pressure. And a few months later, the CFO is out, and then the next quarter they miss and the stock is down, right? So that was an example. That's not something that you're going to be short forever. That's not something that's a fraud. There's no fictitious revenue, but it's an event where there's a substantial divergence between what the people that were long the stock thought and what was really happening. There were enough rumors, I think, swirling around it when it went public. People were questioning this, so it wasn't like, no one saw this coming. There was short interest in the stock. That's the kind of situation that I think can be adapted or sort of used in an activist way, where it's not the traditional method, but it's also less risky than the traditional method, because you're not calling people frauds and liars, and you're just saying, hey, here's what I found, here's what you seem to think is happening, here's what I think is happening, let's see what happens. And I think you can build just as good of a track record off of that as you could otherwise.